All right, we'll turn now to our daily business segment with Charles Pellegrin. Today we'll be focusing on China's struggling economy. Charles.
That's right, Aaron. Hopes were high that China would be running at full throttle after lifting its restricted COVID policies at the end of 2022, but that hasn't really materialized. Consumer spending is weak, with even risks of sustained deflation. The consumer price index fell by 0.3% in July. And youth unemployment being at record highs, over 20%, is also not helping in that regard. Now, exports fell dramatically last month, too, down 14.5%, the worst performance since February 2020, when that was the height of the pandemic, on the back of weak global demand. And the export sector represents about 20% of the country's GDP. And on top of that, the property crisis is continuing. The real estate sector represents anywhere between 15 to 30% of GDP, depending on estimates. And real estate giant Evergrande is still trying to sort out a deal with its major creditors after hitting a liquidity crisis, and it filed for bankruptcy protection in the U.S. last week. Another huge group, Country Garden, has announced losses of over $7 billion for the first half of the year and will be delisted from the Hong Kong Stock Exchange on September 4th.
So given all of that, Charles, economists have been calling for some form of stimulus to help revive the economy, but that hasn't happened yet.
Financial regulators actually held a meeting with banks last week where they asked them to boost loans. But the few moves that have taken place aren't considered sufficient to really stimulate demand. This Monday, for instance, the People's Bank of China announced it was cutting one of its key interest rates for the second time in 3 months. The one-year loan prime rate is the basis for most business and household loans, for example, to invest in buying a new car, and it was cut by 10 basis points to 3.45%. And the 5-year loan prime rate, which is the basis for most mortgages, stayed unchanged, though, at 4.2%. Expectations by economists had been for a 15 basis point cut on both of these rates, especially because of the default risk in the property sector.
So what has the reaction been like on the stock markets, Charles?
Well, whether it's on the mainland or in Hong Kong, the stock markets traded lower on the back of that news. We'll see those figures come up shortly. The Shenzhen Stock Exchange down over 1%. The same goes for the Shanghai Composite, and the Hang Seng in Hong Kong also trading lower currently.
What do you think is holding authorities back when it comes to stimulus?
Well, one simple answer is a concern for financial stability because of the dire financial situation of many local governments that are now saddled with bad debt after years of spending, a situation that is made worse now by the property crisis. Many of these local governments, authorities, used to generate a lot of their revenue thanks to land sales. Now, the central government is hesitant about supporting the economy with fiscal policies, in part because of that debt issue. Resolving the issue of financial risk is now a top priority of the ruling party. A new commission for financial stability was created back in March to enhance the Communist Party's control over the financial industry.
Charles Pellegrin, our business editor, thank you very much.